Welcome to Video20E on partnership allocations and basis. So there are two ways to measure partnership basis. The first and the most common one is outside basis. An outside basis is the basis a partner has in their own partnership interest. So for example, SpongeBob contributes cash at $10,000 and land with a fair market value of $150,000 and basis at $20,000 to Krusty Krab partnership. So we know the basis carries over. As a result, SpongeBob has outside basis, that's his basis and his investment in the partnership, of $30,000. $10,000 from the cash, $20,000 from the land that he contributed. If he were to sell his interest, when we think about having the amount realized minus the adjusted basis results in a realized gain or loss, then we know that his adjusted basis portion of that realized gain or loss calculation is $30,000. And we're also going to see that outside basis is used as the limit for losses. And we'll cover that a couple videos from now, even though we've already covered it somewhat in the past. Inside basis is the basis that the partnership has in the assets of the partnership. For example, Krusty Krab partnership takes the same carryover basis of $20,000 in the land. If the partnership were to sell the land, the adjusted basis portion of the realized gain or loss calculation, amount realized minus adjusted basis, the adjusted basis portion is $20,000. So when we think about calculating basis, it's not as simple as it was for property back in the depreciation era. So partners make the following adjustments to basis in their partnership interest annually. So first, they increase it for any actual and deemed cash contributions to the partnership during the year. So actual contributions, that's pretty straightforward. Deemed contributions, those come from when the partnership takes on more debt. Then they increase their basis for their share of ordinary business income and separately stated income or gain items and any tax-exempt income items. Then they decrease their basis for any actual and deemed cash distributions during the year. And then lastly, they decrease their basis for their share of losses or non-deductible expenses or any separately stated expense or loss items. So SpongeBob contributes cash at $10,000 and land with a fair market value of $150, basis $20,000 to the Krusty Krab partnership in exchange for a 50% interest. Then in year one, the Krusty Krab generates ordinary income of $20,000, long-term cap gains of $3,000, tax-exempt income of $4,000, and the Krusty Krab makes a $3,000 distribution to SpongeBob. All right, let's calculate his basis. So his initial basis is 0. He gets basis for the carryover basis of the cash and property he contributed. That's $30,000. Then we're going to add the income items. That's half of the ordinary income and half of the long-term capital gains. Then we'll add half of the non-taxable income items. That's his half of the $4,000 of tax-exempt income. Then we reduce it by the $3,000 of cash distributions. There were no loss items and no non-deductible items, giving us the basis at year end of $39,500. And you can see what happens is basically basis is a catch-all for all the transactions that run through the partnership. Okay, now everything's the same except that the Krusty Krab also borrows recourse debt of $40,000 and it's allocated based on capital interest. So of course SpongeBob gets half. Now when we do this calculation, the contributions of cash and property are increased by the deemed contribution that occurs when the partnership takes on more debt. Since half of that belongs to SpongeBob, or $20,000, then now his contributions of cash and property are up to $50,000. Pretty much everything is the same, leaving basis at year end as $59,500. So you can see how debt becomes part of basis. In year two, the Krusty Krab incurs an ordinary business loss of $24,000, has a 12/31 gain of $4,000, and makes a cash distribution of $4,000 to SpongeBob, and it also pays down its debt from $40,000 to $30,000. Okay, let's track these items through basis. So recall that our initial basis is 59.5 at the beginning of the year. That's what it was at the end of the year. So the contributions of cash and property are 0 this time. The income items are SpongeBob's share of the 12/31 gain of $2,000. There's no tax-exempt income. And then we have cash distribution. So that's the $4,000 distribution to SpongeBob. And then his share of deemed distribution from the paydown of the debt. So since the debt was paid down $10,000, his half of that is $5,000. $5,000 plus the $4,000 actual distribution is a $9,000 distribution. The loss items are $12,000, his share of the ordinary business loss, leaving him basis at year end of $40,500. So cash distributions in operating partnerships, we're going to talk about this in a subsequent video, but let's keep going anyway. Partners are taxed on income when the partnership earns it, but of course not when the cash is distributed. I think we've got that down by now. If cash is distributed when partners have a positive tax basis in their partnership interest, the distribution effectively represents a distribution of the profits that have been previously taxed, or a return of capital of cash previously contributed by the partner to the partnership, or a distribution of the cash the partnership has borrowed, or of course some combination of those three. And cash distributions that are either deemed or actual in excess of the partner's basis are taxable and generally treated as capital gains. In year 3, the Krusty Krab incurs an ordinary business loss of $60,000 and then pays down its debt from $30,000 down to 0, so pays off all its debt. The beginning basis is $40,500. Recall that's what we ended with from year 2. There are no contributions of cash. There are no income items. There's no non-taxable income. However, we did make a cash distribution of $15,000. So that is a deemed distribution. So our basis after distribution, notice that I've inserted a little subtotal here, is $25,500. And the reason I've inserted that is because SpongeBob's share of the ordinary business loss is $30,000. But that would create negative basis. SpongeBob can't have negative basis. So as a result, the loss item allocated to him is $25,500, which means that the additional $4,500 distribution is in excess of basis and would be treated as a capital gain. Okay. So when it comes to allocations, we know that partnerships can be flexible, right? And they can actually be really flexible about how income and losses are allocated to the different partners. But it's not without some restriction. So these restrictions are really beyond the scope of this course, but I want you to be aware that they exist, at least in theory. So one is called substantial economic effect, which means that if I take into account all the facts and circumstances, the allocation is in accordance with the member's interest in the partnership. And really, again, the concept is beyond the scope of this course. Probably all you need to know at this point is that allocations have to have substantial economic effect. If for some reason they don't, then at a minimum they must reflect the partner's interest in the partnership. And the partner's interest in the partnership means that the partner's allocation are reflected in the ultimate liquidation of the partnership. So this is also beyond the scope of this course, but understanding that there are these limits, substantial economic effect or partner's interest in the partnership, that's reasonably important. Okay, lastly, there's a rule that requires there to be a built-in gain allocation to the extent that a contributing partner contributes property that had a built-in gain at the time of the contribution. So SpongeBob and Patrick form the Krusty Krab partnership. SpongeBob contributes cash of $50,000. Patrick contributes land worth $50,000. And this particular land has a 0 basis. So Krusty Krab sells the land now. The partnership sells the land for $60,000. And as a result, because it takes the carryover basis, it generates a $60,000 long-term capital gain. So in the ordinary course of business, that gain would be allocated 50% to SpongeBob, 50% to Patrick. But SpongeBob cries unfair and says, look, basically all, or not all, but most of the gain that was earned was prior to him being part owner of that land through its contribution to the partnership. The reality is it was Patrick who contributed when the market value was 50 and the basis was 0. And SpongeBob basically says, why should I have to pay tax on the gain that occurred before I was part owner of that property? So instead, the built-in gain at the time of the contribution is allocated back solely to Patrick. So as a result, when that gain is allocated, the $50,000 worth of gain would be allocated to Patrick. That was the built-in gain at the contribution. And then that remaining $10,000 worth of gain, that would be split in accordance with the partnership agreement, or perhaps 50-50 between SpongeBob and Patrick. That brings us to the end of Video 20E. Thanks for watching.